Hello everyone, my name is Josh Enomoto. Welcome to InvestorThread.com. Today we're going to talk about the bull put spread options strategy to generate quick yield from various publicly traded opportunities and enterprises. And so one of the concepts or misconceptions about the equity space is that you always have to speculate on a certain event materializing, basically to buy low and sell high. And that buy low and sell high concept is, technically speaking, it's known as a debit-based strategy. You pay either a premium in the case of a call option, or you pay the various administrative fees in order to buy a security. You're buying the security at the ask. Okay, so that's a little bit of a premium to the open market price of a security, and that is your debit. And then you're hoping that the underlying asset, the commodity or the security, rises in value. Not only rises in terms of the open market valuation, but also rises enough to exceed the premium that you paid, the debit that you paid. And that type of speculation, it's more of a direct speculation. It's an intuitive speculation. That's the idea that I would say most retail investors think about when they think about investing or trading in the equities market. But there's also the other component. There's the credit component, because just like in accounting, you have your debits and credits, right? In terms of stock trading, if somebody's paying a debit, somebody is also receiving the counteracting credit. And with options, what is so profound about options is that there's a misconception here. There's an opportunity gap, because once people realize they don't always have to apply a debit-based strategy, they can actually deploy a credit-based strategy. That changes the entire thinking. That changes the entire paradigm. For instance, if you're not winning too many football games because you keep going for it on fourth down, there's a reason why, because you're not always supposed to go for it on fourth down. Sometimes your offense just gets bogged down and you need to give up the ball, but you need to give up the ball strategically. So you punt the ball. And that's sort of like what we're doing with a credit-based strategy. It's not, we're not thinking in terms of offense, but we're thinking in terms of strategic defense. Okay, so we're punting the ball, and we're essentially wagering that our defense will prevent the other side's offense from marching up the field. And then we, in turn, can get the ball back, or we can get the ball back in more favorable circumstances. So that is the basis of a credit-based strategy. And it can be very powerful because, again, with in any debit-based strategy, somebody's paying a debit, but then on the other side of that transaction, someone is receiving the credit. And in the case of a bull put spread, we are receiving the credit. We're receiving the reward up front and hoping that the other side, their position blows up in a bad way, and that way we can keep the income that we earned up front. So one idea to consider is the SPY ETF, SPY, the SPY ETF. But rather than buying the SPY ETF itself, which is a debit-based approach, we want to deploy a bull put spread. Now, as you might imagine, we are going to, we're talking about a bull put spread. We are deploying put options. The difference between just deploying, buying a put option, which is also a debit-based strategy, we are selling puts. Now, selling options is, of course, risky in and of itself, because in case the position goes against us, then the other side can exercise the contract, and then we are essentially assigned. We are obligated to fulfill the terms of that contract. So writing or selling options, whether they be calls or puts, can be incredibly dangerous. And on in the situation of selling call options, because there is no theoretical limit to how high a stock or asset can rise, selling call options has that added danger of essentially unlimited liability. We're not going to get into that topic because we're talking about a bull put spread. We are selling put options, but at the same time, we're also buying put options so that we cap the risk of the put option that we sold. And we're going to buy a put option at a lower strike just in case the position goes against us, as in the security moves significantly downward. The lower put option that we bought, even though the security or asset falls down, we cap our losses. That's why we buy the put. We sell the put at a higher strike to generate the income, but we also buy a put at a lower strike price to cap off that risk just in case the trade goes against us. Okay, and so the idea for the SPY, one of the reasons why it's so popular, aside from the heavy participation, the high volume, is that the SPY is basically traded practically every business day. So there are myriad options chains available. Okay. But in particular, I'm just going to throw this out as an idea. This is not investment advice. This is not trading advice. I'm just throwing it out as an idea. The options chain that expires this coming, next Friday. So October 11th. Okay, right now it's October 4th. October 11th, this particular option chain will expire. And one idea to consider is to sell the $568 put, and which was at the time had a bid of $2.56, and then we simultaneously buy the 566 put, and that was trading at an ask of $2.13. The max reward comes out to the net income that we received. So we received a gross income of $256, but we also bought some downside protection at $2.13. So the difference comes out to 43 cents per contract, or $43 when applying the multiplier of 100 shares per contract. And then the max loss comes out to $1.57, okay, or $157 when you apply when multiplied by 100 shares. So $43 is the most that we can receive in this trade, and the most that we can lose is $157. The risk reward comes out to 3.65 to 1, which means that for every $1 of income that we receive, we put $3.65 at risk. Another way to look at this is that the yield that we can potentially generate from this trade is 27.39%. So over 27% yield, and this is just in 1 week's time, 1 business week's worth of trading activity. If this trade moves in our favor, we would essentially receive a yield of 27 or over 27%. You're not going to find yields of over 27% in just 1 week, in 1 business week. Okay, that's the power of the bull put spread, and that's the power of credit-based strategies. If you know what you're doing, if you know the ideas and the opportunities available to you, and it's just having the knowledge of this framework. Because a lot of people, they just trade in a speculative debit-based way, and I'm saying no. Sometimes you want to approach in a credit-based manner. Here's the fundamental reason. One of the reasons that you may want to consider a credit-based to the upside, the bull put spread, as opposed to a bearish. A bear call spread would be exactly this type of credit-based approach, but assuming that the security will go down. That's the bear call spread. We're talking about the bull put spread, which assumes that essentially the security will or asset will move sideways or march moderately higher. Okay, and the reason why fundamentally we may want to consider a credit up framework, if you will, is that we just got the jobs report. It came in stronger than expected, so people are more confident about the economy, and yet there's still some concerns and jitters about the valuation of the equities market itself. So there's a little bit of a tug and war, but broadly speaking, people's fears of a economic crisis and economic recession, that was soothed because of the jobs report came in stronger than expected. So that should be net positive for the equities market, even though there are some concerns about high valuations, particularly in the tech sector, the AI sector. But despite that, again, we should see a net positive sentiment. At least that's one way of looking at it. At least that's my opinion on the matter. And if you believe in that framework, if you believe in that narrative, slightly positive, then a bull put spread can be very powerful. And in just one business week, you could potentially gain a yield of over 27%. Now, what makes this idea so intriguing, let me just look at the price of the SPY ETF. Right now, it's trading at, it closed Friday at 572.98, so just under 573. Okay, so just under 573. And if I look at the technical framework here, it certainly appears that there is around the 568 level, there does seem to be horizontal support. And I'm not saying that you have to be a big technical analysis expert, and I'm not even entirely sure about the scientific validity of the technical analysis approach. But nevertheless, it does seem, when I'm just looking at the chart, it does seem that there is a support line there at 568. The thing is, it doesn't need to hold indefinitely, right? When I reference the technical approach, and some people may not really care about the technical approach or think it's just a bunch of voodoo. Fine, it may be voodoo, but the reality is that a lot of people are looking at, a lot of analysts are looking at the technical approach. And also, keep in mind, we're not saying that the SPY needs to hold 568 indefinitely, right? It doesn't need to hold 568 till the end of time. It just needs to hold 568 till the end of next week. That's it. We're not looking for anything more than that. And if it can stay at or above 568 throughout this week, by the time next Friday rolls up and it's at or above 568, guess what? You collected the maximum reward of 43 cents per contract, comes out to $43 when you apply the options multiplier, and $43. Now, yeah, it doesn't sound like much, but then if you buy multiple contracts, then you could obviously compound your rewards. Percentage-wise, you're looking, that's the main focus. Do you want a yield of over 27%? A lot of people will say yes. Now, of course, this is not risk-free yield. Obviously, if you're going to look for a risk-free yield, you would look at something like treasuries and get your 3 or 4 or whatever percent. But in terms of added risk yield on over a course of 1 week, 27%, you're not going to find opportunities like this. The other thing to consider is that this is a pretty high probability trade. Now, just looking at the metrics here, and was able to populate this information using Bar Chart Premier. Bar Chart Premier is one of the most powerful tools. In my opinion, this is the most powerful tool ever, because just for basically, essentially it comes out to a Netflix subscription. You can have access to all kinds of compelling ideas and opportunities. If you don't have Bar Chart Premier, frankly, it's like eating soup with a fork. You can do it, but it's going to take a very, very, very long time. I'm going to, over future videos, I'm going to show you exactly the advantage that Bar Chart Premier offers, and you will come to the same conclusion. If without Bar Chart Premier and you're trying to do this on your own through platforms like Yahoo Finance that are free, but if you're trying to duplicate what Bar Chart Premier is doing, it is like eating soup with a fork. It is ridiculously difficult. Anyways, I can't find this particular trade at the moment. There's so many of them, but from what I remember, the probability, the probability of success was above 60%. I think it was like something like 65% probability of success. Meaning that there is a good 65% chance that this trade that I just discussed will at least be somewhat profitable. Okay, and that's pretty good, especially when you're getting over 27% of yield. If assuming this trade goes well, you're getting over 27% of yield in one business week. You're just not going to find too many of those ideas out there. So I just wanted to present one idea, and that was just one idea in the SPY. The SPY is a boring asset, right? Everybody knows it's a boring asset, and yet you can make a ton of money with a boring asset if you know what you're doing. And that's the purpose of investorthread.com, is to share this knowledge and democratize this information, because there's a lot of stuff available to retail investors that, let's put it this way. There's a lot of inefficiencies, and this inefficiency stems from a lack of education, simply because people don't know Wall Street, and the professionals in the Wall Street machinery are able to manipulate or able to able to get one over the regular folks. And so by arming you with this information, arming you with this knowledge, this helps to take the veil off, and you can see more of what the professional traders are seeing and more what the professional traders are doing, and participate in that. And that helps to correct the knowledge inefficiency, this knowledge gap, allows for a much more equitable situation. And that's what that's what we're all about, is promoting equity, promoting real equity in the equities market. So that's one idea in the SPY. It is a very interesting idea in a not so particularly exciting ETF, but it's there. And with options trading and with the knowledge of more advanced skill sets, and these aren't really advanced, these are pretty simple multi-leg transactions. Just by having a few tools in your tool belt, you can dramatically improve your abilities in the market, and also extract opportunities that you may have not even thought about. So that's it for today, and please check out investorthread.com for more trading ideas. Thank you.